Today is Monday, April 7th, and we are now officially in a bear market. But the reality is that there has been ample evidence that this market has not been healthy. So we would argue that you should have already deployed defensive strategies in your portfolio. On the screen right now, I've got the S&P 500 SPY ETF, and you can see as of about 10 o'clock this morning, it has traded down approximately 20% from the highs. If you look at the equal weight version, you see the same thing. Again, not a healthy market, but the reality is there's been growing evidence that this is not healthy. So we would argue that you should have already deployed defensive portfolio strategies. So now that we're in a bear market, all the talking heads, all the media experts are giving us the same sermon they give us every single time that we go through a bear market. And for the most part, I'm going to tell you, this is simply bad doctrine. So let's walk through these points one by one. First up, the market always comes back. The reality is that, yes, so far the stock market has always come back, but that doesn't mean that this time it's going to come back in the time frame that you have available. For example, if you're trying to retire next year, is the stock market going to recover in time for you to still hit that retirement goal? I can't guarantee that. So the fact that the stock market always comes back, yes, that is true, but not always in the time frame that you have available. So let's talk about volatility. During a market crisis, we start to see analysts and media pundits talk about how damaging it would be to your portfolio's return if you missed the best 10 days inside of a stock market year. And since you can't predict when those days are going to occur, they say you should just stay invested. Well, what they very rarely, if ever, show you is how much money you would actually save if you missed the worst 10 days in a stock market's year. The reality is volatility begets volatility. And so in periods of increased volatility, sometimes it makes sense to put on a defensive strategy to protect the principal, to protect the hard-earned capital that you have so that you can still hit your financial goal. The next cliche is stay the course. And if we're talking about your financial plan, then I would say amen. Stick to the discipline of the financial plan that you and your advisor have designed for you. However, that is not the same thing as making a portfolio decision. Too many times people confuse financial planning with portfolio management. They are two completely different skill sets. Make no mistake, I'm not suggesting that you try to start timing the market. That's not what I'm suggesting. I'm also saying that I do agree with this last bullet point. Don't panic. You should not be panicking in times like this, but you should follow your process. The question is, do you have an investment process? If you've hired somebody else to manage your wealth, whether it's multiple millions, 1 million, or $500,000, it's still your wealth. Is there a defensive strategy for times when it's needed? If you have any questions, let me know.